You're in a pinch. Rent's due, cars acting up, or maybe you just need a little extra cash to seize an opportunity. You've heard about Possible Finance, right? It's one of those new age lending platforms promising quick cash without the hassle of traditional credit checks. But here's the burning question. Does Possible Finance actually check your credit? Let's dive in. Now, the short answer might surprise you. No, Possible Finance doesn't pull your traditional credit report the way a bank would for a mortgage or a car loan. They're not interested in your FICO score or your payment history on that old student loan. Instead, they take a different approach. Think of it like this. Traditional lenders focus on your past financial behavior. They want to know if you're a reliable borrower based on what you've done in the past. Possible Finance, on the other hand, is more concerned about your present financial situation. They want to know if you can afford to repay the loan based on your current income and spending habits. To figure this out, Possible Finance looks at your bank account. They analyze your income, expenses, and spending patterns. They want to see a consistent income stream coming in and reasonable spending habits. It's like they're taking a financial snapshot of your life right now. So, while they're not checking your credit score, they are definitely assessing your financial health. And in some ways, this might be even more revealing than a traditional credit check. After all, your past doesn't always predict your future. What matters is your ability to manage your money today. But here's the thing. Just because Possible Finance doesn't check your credit doesn't mean you're guaranteed to get a loan. If your income is too low or your expenses are too high, you might get declined. And even if you do get approved, the interest rates might be higher than you'd expect. Why? Because Possible Finance is taking on more risk. By lending to people without traditional credit scores, they're betting that these borrowers will repay their loans. To compensate for this risk, they charge higher interest rates. So, is Possible Finance right for you? That depends on your financial situation. If you have a steady income, low expenses, and need a small loan quickly, it could be an option. But if you're struggling to make ends meet or have a history of financial problems, you might want to explore other options. And let's talk about the potential downsides. While Possible Finance might offer a quick cash solution, it's important to be aware of the potential for debt traps. These loans can be expensive, and if you're not careful, you could find yourself in a cycle of borrowing to repay borrowing. It's also worth mentioning that building credit is important for your long-term financial health. While Possible Finance doesn't report to credit bureaus, using traditional credit products like credit cards responsibly can help you establish a good credit score. A strong credit score can open doors to better interest rates on loans, mortgages, and even car insurance. So, while Possible Finance might be a tempting option in a pinch, it's essential to weigh the pros and cons carefully. Understand how it works, know your financial situation, and consider the long-term implications. With that said, thanks for watching, and until next time.